Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore and beyond. Today, we're diving deep into a specific SGX listed stock, dissecting an analyst report to see what it really means for your portfolio. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about gaining an edge in the Singapore market, you'll want to hear this and consider how our premium insights can help you even more. Today's spotlight is on ST Engineering, and we're breaking down RHB's latest analyst report that just raised their target price to $8.90 from $8.30 while maintaining their buy rating. But here's what caught my attention. RHB analyst Shekhar Jaiswal noted that ST Engineering's share price gains have actually lagged behind its regional peers this year. That's fascinating because when you dig deeper into the numbers, there's a compelling story here that most retail investors are missing. Let me walk you through exactly what this analyst report reveals, why the valuation upgrade matters for your portfolio, and most importantly, whether this blue chip defense giant deserves a spot in your CPF or SRS investments. We'll cover ST Engineering's explosive contract wins, their ambitious 2029 growth targets, the dividend story that's getting investors excited, and the risks that could derail this defense, darling. Starting with the financial performance that's driving this analyst optimism, ST Engineering delivered solid results for 2024. The company posted revenue of $11.28 billion, up 12% year on year, with net profits surging 20% to $702 million. But here's where it gets interesting for Singapore investors. This isn't just about one good year. The company secured $4.4 billion in new contracts in the first quarter of 2025. Think about that for a moment. In 3 months, they locked in contracts worth nearly 40% of their entire 2024 revenue. Now, why does this matter for your investment strategy? ST Engineering operates in 3 key segments that are all benefiting from major global trends. Their commercial aerospace division is riding the post-pandemic recovery wave. Their defense and public security segment is capitalizing on rising global defense spending. And their urban solutions business is tapping into Singapore's smart city initiatives. It's like owning a piece of 3 different growth stories in one stock. The defense angle is particularly compelling right now. RHB's analysts specifically highlighted ST Engineering's growing potential for international defense contract wins and their increasing capabilities in conventional and digital defense. This isn't just analyst speak, it's backed by real numbers. The defense and public security segment won $2.7 billion in new contracts in Q1 2025 alone. When geopolitical tensions are rising globally, defense contractors like ST Engineering become more valuable, not less. But let's talk about what this means for your CPF or SRS portfolio. ST Engineering currently trades around $7.95, which puts it below most analyst target prices. The consensus target price sits at $8.30, with RHB now at the higher end at $8.90. For conservative Singapore investors, this represents a potential 12% upside based on professional analysis. More importantly, ST Engineering offers a dividend yield of around 2.1%. And here's the kicker. They announced an enhanced dividend policy where they plan to propose 18 cents per share for FY 2025, up from 17 cents in 2024. Now that we've covered the growth story, let's pivot to the valuation question that's keeping some investors on the sidelines. ST Engineering's current price-to-earnings ratio sits around 33 to 35 times, which is significantly higher than its 10-year average of around 22 times. This premium valuation reflects market expectations for continued growth, but it also means there's less margin for error. Think of it like buying an HDB flat in a prime location. You're paying more upfront because you expect better long-term returns, but you need to be confident about the fundamentals. The company's ambitious 2029 targets provide some context for this premium. ST Engineering aims to reach $17 billion in revenue by 2029, with net profit growing even faster than revenue. They're targeting their commercial aerospace segment to hit $6 billion in revenue, defense, and public security to reach more than $7.5 billion, and smart city solutions to grow to $4.5 billion. These aren't just pie-in-the-sky projections. The company has a track record of meeting their targets, having achieved most of their previous 2026 goals ahead of schedule. Here's where the Singapore context becomes crucial. ST Engineering isn't just any defense company. It's essentially Singapore's national champion in the sector, with strong government backing through Temasek's ownership stake of over 51%. This provides a level of stability that you don't get with pure commercial players. For SRS investors looking for blue-chip exposure with growth potential, this government connection offers downside protection while still allowing upside participation. The risk factors deserve equal attention, though. The company faces potential headwinds from trade tensions, particularly with tariff policies potentially affecting their China operations. ST Engineering has acknowledged that tariff impacts could affect up to $40 million in monthly revenue from their engine MRO work in China. While this represents a small portion of their total business, it's a reminder that global trade dynamics can impact even well-diversified companies. Another consideration is the cyclical nature of the aerospace industry. While defense spending tends to be more stable, commercial aerospace can be volatile based on airline industry health and aircraft production cycles. ST Engineering's diversification helps, but investors should understand that they're still exposed to these broader industry cycles. For CPF investors specifically, ST Engineering offers an interesting proposition. The stock is available for CPF investment, and its dividend yield combined with potential capital appreciation could help boost your retirement savings beyond the standard CPF interest rates. However, the current premium valuation means timing matters more than usual. Dollar cost averaging through regular CPF top-ups might be a prudent approach rather than making a large lump sum investment at current levels. The competitive landscape also plays into the investment thesis. ST Engineering competes globally with much larger players like Boeing, Airbus, and major defense contractors. However, their niche focus on MRO services, especially for LEAP engines, gives them a competitive moat. They've built relationships with airlines across Asia and the Middle East that aren't easily replicated. It's similar to how Singapore's port operations compete globally, not through size alone, but through efficiency and strategic positioning. Looking at the broader economic context, ST Engineering benefits from several tailwinds that are particularly relevant for Singapore-based investors. Rising defense spending across Asia-Pacific, the ongoing digitalization of urban infrastructure, and the recovery in commercial aviation all support their business model. Singapore's own Smart Nation initiatives create a natural testing ground and reference market for their urban solutions. Now, for Iggy's personal take on this analyst report and ST Engineering as an investment, I agree with RHB's buy rating, but with some important caveats. The analyst is right about ST Engineering's strong fundamentals and growth potential, especially in defense and digital solutions. The company has consistently delivered on their promises, and their order book of $28.5 billion provides excellent revenue visibility. However, I think the current valuation already reflects much of this optimism. Here's where I might differ slightly from the analyst consensus. While the long-term story is compelling, I see some near-term headwinds that could create better entry points. The premium valuation means any disappointment in quarterly results could lead to significant price corrections. We've already seen volatility in the stock despite strong fundamentals. For Singapore investors, I view ST Engineering as a core holding rather than a growth play at current prices. If you're building a diversified portfolio through your SRS, this stock deserves consideration, but I'd recommend dollar cost averaging rather than making a large initial investment. The enhanced dividend policy makes it more attractive for income-focused investors, but growth investors might find better risk-adjusted returns elsewhere at current valuations. My biggest concern isn't with the business fundamentals. Those remain strong. It's with the market's expectations. When a stock trades at 33 to 35 times earnings, there's little room for execution stumbles or external shocks. The China tariff situation, while manageable, shows how external factors can impact even well-run companies. That said, for long-term CPF investors with a 10 to 15-year horizon, ST Engineering represents quality exposure to defense, aerospace, and smart city themes. The government backing provides downside protection, and the company's track record suggests they can navigate challenges effectively. I rated a hold at current levels, with a buy rating if it drops below $7.20. So, we've dissected this SGX stock, looked at the analyst report, and I've given you my personal take. ST Engineering offers compelling long-term growth prospects backed by strong fundamentals, but current valuations require patience and careful position sizing. The defense and smart city themes remain attractive, especially for Singapore-focused portfolios. Now, if you found this level of in-depth analysis truly valuable and want to seriously level up your investing game, imagine getting daily premium insights delivered to you up to a week before anyone else sees them. That's what our members get for just $1 a month, less than a cup of coffee. You'll unlock a wealth of additional content, including daily market analysis, early insights into promising trends, and even deeper dives into specific investment strategies relevant to Singaporean investors. Think of it as your consistent daily dose of financial fuel for smarter decisions. Ready to join the inner circle? Just click the link in the description below to become a member. Don't forget to like this video if it helped clarify ST Engineering's investment case. Subscribe for more SGX deep dives and drop a comment about which stock you'd like me to analyze next. For your next watch, check out my detailed breakdown of CPF investment strategies and how to maximize your SRS contributions. It's the perfect complement to today's analysis and will help you make the most of Singapore's retirement planning tools.